Hey everyone, welcome back to Corporate Decoder, the place where we decipher corporate filings because, let's be honest, who really understands those things? Today, we're diving into the latest report from PHINIA, that's PHINIA, and just from reading the cover page, I'm already expecting some financial acrobatics. Buckle up, because despite some promising tech, their first quarter numbers tell a story of sales slowing down and profits being squeezed. For the 3 months ended in March of 2025, the company filed what's called a 10Q, which is basically a quarterly financial snapshot. This report tells us how well or not so well the company did. PHINIA, in a nutshell, makes parts for cars, trucks, and industrial equipment, basically things to make engines work better and cleaner. They sell these parts to big car companies and also to your local mechanic. This company was part of BorgWarner until just last year when it was spun off, meaning it became its own independent company. Being a brand new public company means this report is important to see how they are doing on their own. That split from BorgWarner is important because it changes how we need to look at their finances. First, the good news. They've got some cash on hand, over $370 million, and access to even more through a credit line, almost another $500 million. That's a decent safety net. However, that number is down. They had about $100 million more at the end of last year. Now let's look at the not so great news. Their net sales, which is a company's total sales after accounting for returns and discounts, took a hit. $796 million compared to $863 million the year before. That's a drop of about 8%. Imagine losing almost 1 out of every 12 customers. That's the scale of what we're talking about. Their gross profit, which tells us how efficiently they make their products, also decreased, dropping from $192 million to $172 million. Why this happened is because their cost to produce their products remained about the same, but their sales decreased. Also, let's look at other costs to keep the company running. These costs actually went up slightly from $104 million to $107 million. So they're making less money, but it's costing them more to operate. All of this means their net earnings, which is the real profit, also took a hit from $29 million down to $26 million. So their earnings per share, which is a key number for investors, also went down. It is like saying each slice of the pie becomes slightly smaller. Breaking down where the sales slowdown happened, both their fuel systems and aftermarket segments took a hit, especially the first one. So it isn't just one part of their business that is struggling. Looking at things like goodwill, that didn't change too much, but it's affected by how well the different currencies are doing because they're a global company. They are holding steady with product warranties and their debts are pretty consistent with before. Their debts include senior notes or money they borrowed, plus smaller amounts for things like leases. The company is using some complicated tools to try and limit their damage from currency changes, using some complicated contracts called derivatives and hedging, but it is still a major problem. Looking at other changes to the company balance sheet, you can see the different events that happen, like stocks being issued and bought back along with profits. Beyond the numbers, there's a legal fight brewing with their former parent company, BorgWarner, about who owes what in taxes. It is important to keep an eye on that since it might affect the financials. Now let's switch gears to something important: risk. PHINIA is upfront about the challenges they face. General economic problems, competition, and keeping up with new technology are always threats. Also, they note more specific concerns like what might happen with government rules, trade, and even the weather, and those things can really change things for a parts supplier. So what's the final verdicts? PHINIA is navigating some rough waters, that's for sure. Sales are down, costs are up, and they're in a legal squabble. But they are definitely still afloat. Their strength is that they're planning for the future by investing in zero carbon fuel solutions, although that strategy is far away from paying off. They are exposed to a lot of global risks, particularly in China and Mexico, which are experiencing trade uncertainty. Also, they need to watch their debt and make sure they stay in good standing, otherwise there's risk for this company. If this report was a buffet, it would not be the most appetizing, but it could be a good buy at a discount for an investor willing to bet on it. What do you think? Leave your comments below. Don't forget to like and subscribe for more Corporate Decode insights.